and thank you to all of you for joining us today. As we get started, I want to say that we certainly welcome any comments any of you may have on today's presentation, and we are also interested in hearing from you about any suggestions or specific topics that you would like us to consider for our future webcasts. For your reference, our contact information is provided at the end of the presentation. It is worth noting that the source of all the data being presented today is from the AFS Pricing Dashboard database. This database is the industry source of pricing trends for commercial lending and contains over $1 trillion in commitments, with approximately 80,000 new and renewed loans being added to our database each quarter. In addition, the AFS Pricing Dashboard is used to prepare our monthly Pricing Trends newsletter. If you are interested in receiving our newsletter, you can reach out to me and we will be glad to add you to our mailing list. And if anyone is interested in learning more about our Pricing Dashboard offering, you can reach out to us. Again, our contact information is provided at the end of this presentation. So starting at the top of slide 4, we provide some economic statistics to help put the first quarter results into perspective. First, we can see that following 3 strong quarters, the pace of annualized real GDP growth fell to 2.3% in the latest quarter's release, but was well above the 1Q17 rate of 1.2%. Next, we see oil prices rose to almost $65 at the end of the first quarter. This is an increase of almost $14 from a year ago. And as we will see throughout this webcast, this rebound in oil prices has generated a lot of activity in the mining, oil, and gas sector. Also shown at the bottom of this slide, the 10-year Treasury at the end of March was 2.84%, which is up 36 basis points year over year. Each of these statistics contributes to the U.S. economic outlook, and together with the continued uncertainty surrounding the overall impact of the tax cuts and regulatory relief that seems to be in a holding pattern, presents extraordinary challenges to banks trying to manage their bottom line. On the next slide, we look at rates. This chart is provided to give some insight into the first quarter market rates versus the actual bank pricing. The numbers on the right side of the chart show the year-over-year change, with the arrows indicating if the rates are up or down. Again, we see the 10-year Treasury, the solid blue line, is up 36 basis points year over year. Looking at a shorter time horizon, we can see that the 10-year rate rose 44 basis points since the end of last year. We also see the LIBOR rate, shown as the yellow dashed line, at the end of March was 3.78%, which is up 77 basis points year over year. And the 1-month LIBOR rate, the red line on this chart, is up 90 basis points year over year. We will look into the bank's pricing versus market rates in more detail later in this webcast. As we do in each of our webcasts, we will look at commercial lending with a focus on balance growth, line utilization, new and renewed volume, and pricing for spreads and fees. For our special topic today, Jeremy Charleston will examine if the pricing for C&I loans has kept pace with movements in the broader market rates. So with all this to cover today, let's move to slide 7, where we provide a quick high-level overview of the commercial lending market. Starting at the top left, a quarterly trend of total balance growth is presented. We can see the pace of balance growth in the first quarter remained positive, up 0.4%. We commented in our last webcast that the 2Q17 and 3Q17 growth rates were the slowest 2Q and 3Q growth rates recorded over the last 5 years, and that the 4Q17 growth rate was the second slowest 4Q growth rate over the past 5 years. Now you can see 1Q18's rate is better than 1Q17's growth rate, but a far cry from the rates seen in 2014, 2015, and 2016. The driver of this slowing for 1Q18 is bilateral loans. Balance decreased, resulting in a negative 0.2% growth rate. The top right chart shows that there was a year-over-year increase this month for both new and renewed loans. The chart on the bottom left shows the weighted average LIBOR equivalent spreads for new loans and renewals. Although both new and renewed loan volume was up year over year, the related LIBOR equivalent spreads were down when compared to March 2017. And finally, on the bottom right chart, we see that total annualized fees as of March were very similar to last year's fee levels, with modest increases seen across the major fee categories. With this quick overview as a backdrop, we will now examine how these pricing dynamics are playing out differently across various lending segments. But before we dive into the numbers, in our last webcast, we left wondering if the pro-business policies coming out of Washington would lead to a surge in corporate borrowing. We now know that the first quarter was not as strong as most expected. Although considered solid by some, others are concerned about the slow loan growth. A recent Wall Street Journal article noted that several bankers believe that they expect companies' loan demand to pick up later this year. Others are more pragmatic and recognize that the tax reform is still in its early stages and we are waiting to see the benefits. Another article noted that the new tax laws could provide a cash windfall to companies and thus reduce their near-term need for loans. So what is next? Will the pro-business policies coming out of Washington lead to a surge in corporate borrowing? In our next webcast, we will look into how this all plays out during the second quarter. On the next slide, we take a closer look at the types of loans driving the trend in overall balance growth. The top chart on this slide compares quarter-over-quarter growth rates between bilateral loans, the blue line, and participations, the orange line. For those of you that were on our last webcast or receive our monthly newsletter, you may recall at the end of the fourth quarter, bilateral balance growth quarter over quarter was up 1.29%, while participations finished with a negative rate of 1.06%. At the end of the first quarter, we see a negative quarter over quarter growth rate of 0.2% for bilateral loans, which is the first time since 1Q13 that the quarter over quarter rate was negative. Participation balances reversed the downward trend we saw last quarter and finished in positive territory, up 1.88%. When we segment the growth by various loan sizes, the bottom left chart shows that there was minimal bilateral loan growth in 1Q18 for CRE, and bilateral balances were lower across every C&I loan size segment. For participations, the chart on the right presents a different story. Here, balances only decreased for the greater than $25 million segment, while the smaller loan size segments and CRE reported higher balances for the first quarter. The CRE segment is illustrated in greater detail on slide 10. Here we see that the balance growth for CRE bilateral loans was up 0.7%, which is depicted by the blue time series in the top chart. While CRE participation balances were up from the prior period with a quarter-over-quarter rate of 0.06%, which is much better than the minus 3.6% rate we saw last quarter. Moving to the bottom left chart, we segment the CRE activity for bilateral loans by loan size and see that the loan size segments less than $5 million in size both reported negative growth rates for 1Q18. The two larger loan size segments both reported an increase of less than 1% during the first quarter. The chart on the right shows the first quarter growth for CRE participations. Here we can see that significant growth took place in the two smallest size segments, up 4.67% and 7.52% respectively. The greater than $25 million loan size range shows a decline of approximately 0.5% for the first quarter, which is in stark contrast to the almost 6% growth we saw last quarter. Moving to slide 11, we look at balance growth trends a little differently. Here, the balance growth is measured using a year-over-year growth rates for each month. For example, we computed the growth rate using March 18 versus March 17, and February 18 and February 17, and so on. We then plotted the resulting rates for each month. So in addition to the month-over-month changes that we saw in the preceding slides, this chart provides a way to quickly see how balances are trending on an annual basis. This chart also allows us to better account for seasonal activity. I need to point out that these two charts are plotted using two different scales on the y-axis. The chart on the left presents the aggregate loan trend, and the chart on the right breaks out bilateral loans and participations. As you can see, the growth trend for total loans was trending upward until May 2015 and has seen a significant decline until July 17. In recent months, the trend has held steady and most recently trended up. Moving to the chart on the right, we can see that participations was responsible for the steep decline, even going into negative territory in 2017, while bilateral loan growth remained fairly consistent, but has trended down over the past year. Next, we'll leverage the pricing dashboard's drill-down capabilities to pinpoint specific geographic and industry drivers of balance growth. We start with a look at the state profile. You can think of this as the regional winners and losers. The top 5 states and bottom 5 states are reported. It is important to mention that the geographic data presented in this webcast is based on the location of the borrower, not the location of the bank booking the loan. The chart at the top of slide 12 presents a state view for all loan types and reports the balance growth through March 2018. These charts are based on the change in outstanding dollars to determine the top 5 and bottom 5 states, and then presented ranked by the percentage change. Tennessee reported the largest growth in total balances during the first quarter, up 2.9%. Higher balances in the retail trade sector, more specifically in the building material and gardening equipment subsector, contributed to this growth. We also see Virginia and Texas up 2% or more. The furniture and related product manufacturing subsector was responsible for the higher balances in Virginia, while Texas showed growth within mining, oil, and gas, mostly in the oil and gas extraction subsector. A breakout for bilateral loans is shown in the bottom left chart. Arizona and Oregon both had balance increases well above the national average. The total balance growth we just saw for Tennessee, Virginia, and Texas was mostly due to increases in participation loan balances, as shown in the bottom right chart. Complementing the increase in bilateral balances for California, the bottom right chart shows California also had an increase in participation balances. It is the only top 5 state to report loan growth for both bilateral loans and participations. At the other end of the spectrum, Pennsylvania and Georgia both reported lower balances for both loan types. Using the AFS Pricing Dashboard, you can also examine trends within states. Our pricing dashboard is configured to drill down beyond the state level and view trends for specific core-based statistical areas, or CBSAs. For example, we just saw California in the top 5 states for bilateral loan growth. On slide 13, we can see that 1Q18 growth rate for California exceeded the national average of minus 0.2%, and that the 1Q18 growth rates for Los Angeles and San Jose far surpassed the growth rate for California. However, the growth experienced in the other CBSAs San Francisco, Riverside, and especially San Diego were lower than the aggregate California state rate of 0.62%. This granularity allows us to distinguish the winners and losers very quickly and is the type of data you can leverage to be very competitive in your own market. On the next two slides, we adjust our lens and look not only at the top 5 and bottom 5 states, but the entire country. On slide 14, the colors on the map indicate the level of dollar balance growth experienced by a particular state, with dark green indicating the highest level of growth and red representing a decline. So you can think of this as a balance growth heat map for the balance growth across the country. The map on this slide focuses on bilateral loans, and we can see that balances were down across most states at the end of the first quarter. You can certainly see a lot of red on this slide. However, states such as New York, California, and Massachusetts experienced significant growth in bilateral balances as indicated by the green shading. These three states saw significant gains in the finance and insurance sector, and we also saw increases in the real estate sector in California. The map presented on slide 15 changes our focus to the balance growth for participations. Texas is the top-ranked state for participation loan growth this quarter due to higher balances in the mining, oil, and gas sector. In California, we saw higher balances in the finance and insurance sector, and loans in the manufacturing sector drove participation balances higher in Virginia. However, although balances are up across most states, we can see that participation balances decreased across most of the southern states. In fact, with the exception of Texas and Louisiana, every other southern state reported lower participation balances. As we move to slide 16, we continue our focus on balance growth and highlight the best and worst performing industries. The mining, oil, and gas sector ranked highest for total balance growth in the first quarter, with the largest growth in states like Texas and Florida. As shown by the bottom two charts, wholesale trade ranks among the top 5 fastest growing industries for both bilateral loans and participations, up just under 1% for bilateral loans and up almost 5% for participations. For bilateral loan growth, manufacturing was the first quarter's top industry, especially in states like Minnesota and North Carolina, where the wood product manufacturing subsector saw the highest growth. Honing in on participation growth, we see that in addition to mining, oil, and gas, the wholesale trade sector is also a top performer in the participation space, with growth seen in the merchant wholesaler durable goods subsector in states like Ohio, Wisconsin, and Michigan. On the opposite end of the spectrum, the healthcare sector and the utility sector experienced balance declines for both loan types during the first quarter.
The conference has been muted.
Okay, thank you. A few slides ago, we saw the granularity that the AFS Pricing Dashboard provides users when looking at trends across the country, with insight down to the CBSA level. Our pricing dashboard also lets you examine trends within industries. Industry trends can be analyzed all the way down to a 6-digit NAICS code. On slide 17, we see that within retail trade, motor vehicle and parts dealers had a positive impact on loan growth. Drilling further down to the 6-digit NAICS level, we see that 2 subsectors were responsible for the growth seen during the first quarter: new car dealers and automotive parts and accessory stores, while balances increased to a lesser extent in the used car dealer subsector. This granularity is something for you to consider when you need very detailed data to support your pricing decisions. So far, we have focused solely on geographic views of the data or views only on the industry sectors. With the AFS Pricing Dashboard, users are not restricted to view one dimension at a time. Rather, you can examine cross-sections of regional and industry segments to better understand what is driving balance growth across your own geographic footprint. On slide 18, we highlight each state's top C&I industry for bilateral balance growth. The shading of this map corresponds to the various industry segments as detailed by the legend on the bottom left. For the first quarter, several states with major business centers across the country reported their largest C&I bilateral balance increase in the finance and management of companies segment, which is shown here with the dark blue shading. To help you understand how the industry groupings presented here are defined, the next slide, slide 19, provides a breakdown of the industry groupings. We combine similar two-digit NAICS sectors to create broader industry groups. This helps to present a more concise picture of the industry growth across the country. For example, we combine the three NAICS manufacturing categories into an aggregate manufacturing segment. On the next slide, we'll leverage the same mapping to analyze industry growth across the states for participations. On slide 20, we highlight each state's top C&I industry for participation balance growth. Earlier, we saw that two of the three manufacturing sectors were reported in the top 5 for participation growth in the first quarter. Looking at manufacturing, which is shown here with the light blue shading, we can see that Illinois, along with Iowa to the west, and Kentucky and Virginia to the east, report this segment with the largest growth. In addition, states in the northeast part of the country, like Maine, Connecticut, and New Hampshire, also reported their largest increase in the manufacturing segment for the first quarter. As the last few slides have demonstrated, overall balance growth has been beneath many analysts' expectations, but there are clearly a handful of geographic markets that continue to generate balance growth well above the national average. On slide 21, we present a more concise picture of this dynamic. Here we identify and aggregate the top 10 CBSAs based on their contribution to total U.S. real GDP. The hypothesis is a region's level of economic activity is proportional to its potential for future loan growth. The top 10 CBSAs are illustrated in aggregate by the dark blue bars, whereas the lighter shaded bars represent all other geographic markets. Since March 2016, the pace of total balance growth for the top 10 CBSAs has accelerated during every quarter, far outpacing the growth rate for all other geographic regions. You can see on the far right that while total balances for the top 10 CBSAs continue to grow in 2018, the remaining markets seem to be treading water, hovering around a 2.5% to 3% growth rate. The implication here is that while expectations for loan growth have been tempered as of late, the top 10 CBSAs are continuing to experience significant increases in total loan balances. On the next slide, we look at another component of balance growth, line utilization. For the first quarter, overall line utilization remained relatively flat. So we'll continue to examine these trends and report when there is a meaningful change in these utilization rates. In addition to examining trends in total balances, the AFS Pricing Dashboard enables users to analyze trends for new and renewed loans. At this level, we can better understand the impact of the most recent lending activity. On slide 23, we begin with a look at new and renewed bilateral loans. Starting on the left, we can see that March's new loan volume is slightly lower than last March, and renewal volume is also slightly lower. When compared to the prior month, new loan volume and renewal volume are both higher. Higher new loan balances in the manufacturing of wood products and chemical manufacturing and higher renewal balances in retail trade contributed to the increases we saw for 1Q18. Moving to the chart on the right, we focus on the pricing of the most recent lending activity. The LIBOR equivalent spreads as of March for both new and renewed loans are lower than March of last year. When compared to the previous month, the weighted average LIBOR equivalent spread for new loans went down 24 basis points to 204 basis points. For renewals, the average spread fell to 215 basis points, which is down 3 basis points from the previous month. For your reference, the 10-year Treasury rate is also provided. As mentioned earlier, the 10-year Treasuries for March was 284 basis points, which is 2 basis points lower than February's rate. The drivers of volume and pricing dynamics are presented on slide 24. The charts on the left provide the state and industry distributions of new and renewed bilateral volume for the most recent 6-month period, or in this case, 4Q17 and 1Q18. On the right side of the slide, we present the weighted average LIBOR equivalent spreads for this same list of state and industry segments. This view allows you to quickly see the correlation between loan volume and spread pricing. Focusing on the top of this slide, we can see that California, New York, and Texas captured the highest volume during this period. From a pricing perspective, loans in the mining, oil, and gas sector and professional, scientific, and technical services sector in Texas drove up the average spread for Texas to 280 basis points, while New York was closer to the national average of 216 basis points, driven by finance and insurance loans in New York with a spread of 200 basis points. Moving to the bottom left chart, we can see that finance and insurance outpaced the other industries during this time period. While balances for this sector grew at a high rate, spread pricing was below the all-industry average of 216 basis points, as shown on the bottom right chart. We also see mining, oil, and gas with the highest average spread at 336 basis points, and we saw high spreads across most of the subsectors within this industry. Another industry that reported a high spread is accommodation and food services at 256 basis points, and the traveler accommodation subsector at 262 basis points is responsible for this higher than average spread. Across the top 10 industries, healthcare has the lowest spread at 173 basis points, which is mainly due to loan pricing seen for hospital loans. Next, we will look at the volume and pricing trends for participations. On slide 25, the chart on the left shows that new and renewed participation volume was up in March from both the prior month and the same period a year ago. Looking at the chart on the right, a negative correlation is seen for new loans and renewals when compared to March of last year. Although loan volumes are up, the weighted average LIBOR equivalent spread for new loans is down 29 basis points, and the average spread for renewals fell 22 basis points. When compared to the previous month, a negative correlation is seen once again. With loan volumes up, the weighted average LIBOR equivalent spread for new loans is down 15 basis points, while the average spread for renewals fell 13 basis points. Moving to slide 26, the chart on the top left shows that over the most recent 6-month period, Texas, California, and New York captured the highest new and renewed participation volume. The top right chart shows the pricing characteristics of these states, and we can see that Texas posted an above-average LIBOR equivalent spread of 236 basis points, which can be attributed to loans in the mining, oil, and gas sector. In fact, The average spread in the mining, oil, and gas sector in the state of Texas was 289 basis points. For the second largest state, California, new and renewed loans booked in the finance and insurance sector and the manufacturing of machinery and electrical equipment with spreads of 148 basis points and 159 basis points respectively, accounted for California's below average spread of 169 basis points. On the bottom left chart, we see finance and insurance ranked as the largest sector for new and renewed participation volume. While volume is high in this sector, the average spread of 179 basis points was 19 basis points beneath the all-industry average, as shown on the bottom right chart. Likewise, the manufacturing of machinery and electrical equipment was another large industry for new and renewed participation volume during this period, and also reported an average spread of 182 basis points. Within this industry, the computer and electronic product manufacturing subsector, with a spread of 167 basis points, contributed to this lower than average spread. Next, we look at the final layer of our market review. Slide 27 focuses on commercial loan fee performance. Fee revenue is a vital component of overall bank profitability. On the chart at the top of the slide, we can see that total annualized fees as of March were slightly better than the levels reported in the same period a year ago. As we saw with loan volume and spread pricing, the AFS Pricing Dashboard enables users to examine the regional and industry drivers of fee performance. Mirroring the overall fee trend, the chart on the bottom left shows that for most regions, upfront fee performance was up slightly from the same period a year ago, the exceptions being the South and Southwest regions. From an industry perspective, the bottom right chart shows the industries with the highest fee level were mining and utilities. We saw several six-figure fee amounts for these two industries post during the first quarter. As we've seen throughout this presentation, the pricing dashboard can be used to shed light on loan growth trends for specific geographic and industry segments. Many of our clients are using the dashboard in this precise manner in order to gain strategic intelligence into both new and existing markets. As a template for this type of analysis, on slide 28, we organized the states into 7 broad geographic areas. Let's say, for example, that your bank was thinking of increasing its market share in the eastern Midwest part of the country. The top right map highlights the eastern Midwest region. Using the pricing dashboard, we can see that wholesale trade is one of the top industries for bilateral loan growth in this region. The leading industries for balanced growth across the other areas of the country are shown on the bottom of this slide and on the next slide. This is a quick way to see which industries rank among the best performers across the country. It is also worth mentioning that the AFS Pricing Dashboard allows users to analyze all the major metropolitan areas in the country. To support specific regional pricing strategies, we have also helped users define their own custom regional footprints in an effort to pinpoint specific loan growth opportunities. Please let us know if we can help you with this type of analysis. Again, our contact information is at the end of this presentation. Now for our special topic section of the webcast. Jeremy Charleston will follow up on what we saw earlier. That is, spreads being flat to down over the last year. So we thought it would be interesting to more closely examine the spread over the LIBOR index and see just what segments and industries are seeing the most compression. Having said that, I'll turn it over to Jeremy.
Great. Thank you, Don. So yesterday you probably read that the Federal Open Market Committee decided not to raise interest rates. Still, several banks have projected 1 to 3 Fed rate hikes at some point this year, and short-term interest rates are actually up about 150 basis points when compared to December of 2015. So this got us thinking a lot more about taking a look at trends in loan yields. In this section, we'll examine whether pricing for C&I loans has kept pace with movements in broader market rates. As you might imagine, the story is not uniform when viewed across the participating banks or across various industry sectors. In particular, we'll analyze the risk and return profiles of two large industry exposures in the database, one with an above-average loan yield and another that seems to be showing much greater signs of spread compression. To begin, let's look at how well C&I pricing has kept pace with movements in benchmark rates. The charts in this section focus on C&I bilateral loans tied to the 1-month LIBOR rate. And to give you a sense for the underlying deal volume, slightly more than half of the total bilateral C&I outstandings in the Pricing Dashboard database are priced relative to this particular index. As an interesting side note, the New York Federal Reserve began publishing a new benchmark on April 3rd that could potentially replace LIBOR. It's a measure known as the Secured Overnight Financing Rate. But considering the volume of transactions still tied to LIBOR, we have a long way to go before a replacement rate is widely adopted in the loan market. But back to the analysis, the chart on the left here plots the weighted average interest rate for all C&I bilateral loans in the database tied to 1-month LIBOR. That's the green series on this chart. The dotted black line is the reference rate, the 1-month LIBOR. So you can think of the difference between these two lines as the spread over LIBOR. The two lines haven't moved exactly in lockstep, but clearly both are trending upwards. You can see the changes in both measures more clearly on the right-hand chart. The weighted average interest rate for C&I bilateral loans tied to LIBOR was up 99 basis points in March 2018 when compared to a December 16 baseline, which was a little bit less than the 111 increase that we saw in the 1-month LIBOR index over the same period. Now, there are two possible explanations for why these changes are not identical. First, many banks in their earnings calls highlighted intense and ongoing competition for commercial loans, with one bank describing the market as competitive as it's ever been. Second, and probably more important here, is that there's a slight lag in terms of when the increase in the LIBOR index is absorbed into the weighted average interest rate. To account for this timing difference, we calculated the change in the reference rate on a 1-month lag basis. And on a lag basis, the weighted average interest rate trailed the LIBOR index by only 6 basis points. It was 99 versus 105, that third bar on the chart. 6 basis points of spread compression for LIBOR loans is not substantial. And in fact, the trends shown here indicate that despite intense competition in the C&I market, banks have maintained a relatively stable spread in the total portfolio tied to LIBOR. Now note that this chart includes vintage loans and new renewed activity blended together and differs somewhat from the pricing charts that Don had presented a little bit earlier, which were for new renewed loans only. Spread pricing for new renewed loans seems to be trending below vintage portfolio averages, consistent with the comments banks have made about the competitive conditions in the marketplace. Next, let's see how the performance varies across the banks. And once again, our focus here is C&I bilateral loans tied to 1-month LIBOR. To help present a more concise picture, we calculate a loan beta, or the correlation between the change in 1-month LIBOR and the weighted average interest rate for loans tied to this index. The market average loan beta is 0.89, which is the red line cutting across this chart. And that indicates that the change in weighted average interest rate was less than the change in 1-month LIBOR over the time frame analyzed. As we noted before, most of this difference can be attributed to a lag effect. However, for banks with low loan betas, the result may also reflect competitive pricing pressures across their primary lending industries and regions. Now, the results shown here are based on a subset of the participating pricing dashboard banks. It's not all of them, but just a subset that we thought would illustrate the dispersion in loan betas. For this subset, we observe a moderate degree of dispersion relative to loan beta, reflecting differences in customer, regional, and industry makeups of these institutions. Note that a loan beta greater than 1 would mean that a given bank is seeing its weighted average interest rate increase at a faster pace than 1-month LIBOR. While no bank reported a negative beta, or equivalently, no bank reported a decline in weighted average interest rate for LIBOR loans, about 40% of this subset displayed a loan beta that was beneath the market average. So just why do we see variation among the banks relative to their loan betas? Well, differences in geographic footprints offer one possible explanation. As Don highlighted, some regions of the country are more competitive than others. And while we can't reveal the identities of the banks illustrated here, we can note that the smaller, more regionally focused banks seem to have slightly lower loan betas on average compared with their larger counterparts. So loan betas may be in part a function of bank size and the different pricing practices employed by the regional banks versus the larger institutions. Interestingly, as we look forward over the next few months, the benefits banks gained from changes in the tax policy may indirectly contribute to spread pricing compression. We've heard banks speak of competing away the net benefit in tax policy changes by way of both lower loan rates and higher deposit rates. So it'll be interesting to see over the next few months just how exactly this plays out, particularly for the pricing of new and renewed C&I deals. I think it's helpful and perhaps more meaningful to analyze loan betas in the context of loan growth. Banks with low betas but high rates of loan growth are at least offsetting sluggish increases in pricing with more deal volume. And by that same token, banks with high betas but low levels of loan growth are gaining more in interest income from their existing portfolio. And while we're not suggesting that there's a correlation between balance growth and loan betas, this layout does help organize and categorize our sampling of banks. Banks in the top right quadrant are those what you might call the best-in-class group. These banks report higher loan betas as well as higher rates of loan growth compared with market averages. In today's growth and pricing environment, however, reaching this quadrant is not always feasible. We've heard banks in their earnings calls use words like optimization and de-risking in terms of describing their commercial lending strategies, with these banks pruning loans or segments that don't meet internal risk-return hurdles. Now, while the focus of these strategies is often on exiting unprofitable customer relationships or sectors at risk of overheating, such as some sectors in the CRE space, at times the discussion has centered on exiting industries where loan yields and spreads have become razor thin. Some banks in the top left quadrant may be employing such tactics. Banks in this quadrant report low to negative balance growth, but have also seen their spread on LIBOR loans increase at a faster rate than the market average. So there is a potential trade-off that is indicated on this chart. The industry dimension to this analysis is also very important. Loan betas vary by industry and are often a function of a given sector's access to capital markets and current credit risk profile. Take, for instance, the first two sectors with the highest loan betas, oil and gas and transportation. These industries were severely impacted by the fall in energy prices, and their high loan betas reflect an underlying increase in expected loss projections. Some industries by nature have limited access to capital markets and thus are less price sensitive and more likely to exhibit high loan betas. Many of the mom and pop restaurants in the accommodation and food services industry probably fit this description. Not surprisingly then, this industry has an above average loan beta, as illustrated by the green bar on the far left. By contrast, borrowers in technology-oriented industries may be more conducive to syndicated lending and have a greater array of financing options. We would expect then to see lower loan betas and a higher degree of spread compression in these segments. An example here might be the professional, scientific, and tech sector, which includes engineering, computer, and R&D type firms. As you can see by the red bar on the far right, this industry displays one of the lowest loan betas across the NAICS industry spectrum. So what are the consequences for banks indicated by this chart? Well, banks concentrated more heavily in industries along the right-hand side of the spectrum, the low beta industries that is, may have to give up more spread than, say, banks with larger exposure to industries such as accommodation and transportation. Of course, it can be difficult to untangle all the factors that influence loan beta and the overall desirability of the industries. So to help illustrate these multiple parameters, we present various measures of risk and return in a single view. This chart, which some of you might know as a spider graph, plots a different metric along each pillar of the web. Here we've chosen one of the high beta industries to focus on, namely accommodation and food services. The solid blue line illustrates the relative position of accommodation and food across each metric. The target benchmarks are then shown by the dotted red line. So for instance, at minimum, you'd want the beta of the industry to be 1, equating to no spread compression. For the other metrics, such as balance growth and interest rate, the target benchmark is calculated as the market average. So starting at the 10 o'clock position, we can see that the loan beta for accommodation and food services industry is nearly equal to 1. So the spread compression for LIBOR loans in this industry has been minimal. Looking at the top pillar, we can see that balance growth for this industry outpaced the C&I average over the January 17 to March 2018 period. Moving clockwise, we note that accommodation and food services displays an above average interest rate and fee level with only a slightly higher weighted average risk rating. So I know it's a lot to take in at first, but in summary, the relatively high loan beta for accommodation and food services is complemented by a high level of loan growth and solid risk return fundamentals. The results for accommodation and food services are even more pronounced at the subsector level. Traveler accommodation is the subsector that includes hotels and motels. This particular subsector has a beta north of 1, meaning that its weighted average interest rate for LIBOR loans is increasing at a faster clip than the reference 1-month LIBOR rate. Balance growth for traveler accommodation approached a rate of 20% over the period analyzed, while pricing and fee results for the subsector were also better than average. Unlike the accommodation and food services industry, the professional, scientific, and tech sector displayed a low loan beta beneath the target value of 1. You can see the difference illustrated by the pillar at the 10 o'clock position. If you look at the top pillar here, you'll notice that balance growth for professional, scientific, and tech, which is the solid blue line on this graph, is below the 0 axis, meaning that overall balances contracted for the sector. Across the remaining pillars, the results for the professional, scientific, and tech sector were on par with C&I averages. So it has a low loan beta, a high degree of spread compression, balances are contracting, and its risk-return fundamentals aren't much better than C&I averages. So a very different profile than we saw for accommodation and food services. At the subsector level, the source of the low loan beta seen for the professional, scientific, and tech industry is computer systems design. And I think we're stuck on the prior slide there. There we go. Thank you, Renee. So what we did here is we drilled into one of the subsectors within professional, scientific, and tech, and one of the biggest ones that we saw was computer systems design. The loan beta for this subsector is only 0.68, which translates into a large degree of spread compression for the LIBOR loans booked in this sector from January 2017 through March of this year. Note, however, that balances increased substantially for this particular subsector, so more volume may have helped offset the revenue impact of spread compression for computer systems design. What I think is interesting here, though, is that this subsector displays a higher weighted average interest rate for LIBOR loans than the all industries average. You can see that at the 2 o'clock position on this chart. It might seem hard to reconcile this finding with the subsector's low loan beta, but what this means is that while spread pricing is trending downwards for the subsector, the pricing is still a lot higher than what we see for most other industries across the NAICS spectrum. So a couple of different parameters to balance on this one view. So in summary, loan betas appear to be in part a function of industry, which means that the trajectory of each bank's net interest margin is uniquely affected by the specific makeup of their C&I loan portfolios. Of course, the other half of the equation are the bank's deposit betas. It'll be interesting to see whether loan betas, the ones that we derived here in this analysis, are sufficient to offset the eventual increase in deposit rates and keep net interest margins trending upwards. So that concludes our special topics section. I think actually, Renee, we had one question initially about taking a look at usage again. A couple questions, but while we collect the questions, if we could go back to the usage slide, please. I think there was a question. It'll be, I think, around slide 20. That's 22 rather. Yeah, we had a question about just re-examining usage here. And as Don mentioned, usage rates have been very flat for some time now. We do see some good dispersion among the states and the industries, but we'll pause here and let you digest that while we collect the questions. So we have a question about whether the weighted average calculation for loan beta is based off of variable rates or both variable and fixed. In this particular analysis, we chose to focus just on the LIBOR portfolio, so that would be just variable-based loans.
Renee, can you scroll up to the other, Jay Lee's question?
That's fine.
So there was also a question about how to interpret the differences we see in bilateral versus participation loan growth. And I'm going to assume you're looking at these slides where we contrast the two over several years and for a long period of time. Growth in participations and syndications far exceeded what we saw in bilateral. Now, over the last 9 months or so, both have come back to earth substantially, but certainly for that long run-up, growth in participations and syndications really carried the day and carried the market. And I can give you some color on what we think drives that. Again, for this group of banks in this consortium, right? The first one would be that nearly all of them have invested substantially and considerably in a originate to distribute model, right? So with participations and syndications, a reflection of the value they see in the fee income, but also the value they see in the liquidity of credits of that nature and their ability to trade in and out of positions as opposed to more conventional bilateral lending. The other thing I think that the disparity in that growth shows you is that it clearly indicates how they view the cost to originate, the cost to distribute, and the cost to carry syndicated bilateral loans versus or syndicated participations versus bilateral. So their cost structure, they're telling you is lower. And then the last thing that I would say that's very clear is certainly coming out of the downturn, the expected losses we've seen associated with participation syndications were lower than bilateral loans as well. So again, for this particular group of banks anyway, that would, I hope, explain a lot of the differences in the disparity between those growth trend lines.
And to add to that, our friend from Capital One, we will follow up with you to make sure that we are answering your question accordingly.
Small business in the market.
Small
yes. Yeah, the last question, there's a question about the structure of our data model, and it can allow you to see differences of any kind between metrics between lines of business. So small business, business banking, middle market, so on and so forth. So whether you were talking about spreads, whether you were talking about growth rates, delinquencies, or what have you, that is a capability. And did you answer?
No, we didn't.
Andy?
No. Any rates by term. There's another question asking if we have data by term to maturity, and yes, we can provide that. So if you're interested, please reach out, and we'll be glad to talk with you. And again, we greatly appreciate all the time that you've taken today, and we'll be doing this again next quarter, and we'll talk to you then. Thanks for joining.
Thank you. And also, just as a reminder, we will be emailing out to you a link so that you can listen to and download the slides. Thanks, and have a good day.